You can begin.
Good afternoon and welcome. This is part 2 of our COVID webinar discussion series on the fiscal, monetary, and health policy responses and implications for the economic outlook. Our discussion is sponsored by Princeton University's Griswold Center for Economic Policy Studies, the Center for Health and Wellbeing, and my podcast, A Second Opinion, Rethinking American Health. I'm excited to be here today with Princeton University's Jessica Metcalf, Alan Blinder, and Bill Dudley. Our discussion will look at our current understanding of the fiscal, monetary, and health policy implications of the pandemic, continuing to build on the themes we discussed in our first webinar on April the 2nd, which can be viewed on the Griswold Center website. A little about our three presenters. First, Jessica Metcalf, Assistant Professor of Ecology, Evolutionary Biology, and Public Affairs. She's a disease modeling expert and will kick off the discussion offering the latest understanding of the epidemiological trajectory for the disease and its health policy implications. Alan Blinder, the Gordon Retzler Memorial Professor of Economics and Public Affairs and former Vice Chairman of the Board of Governors of the Federal Reserve. His op-ed, Don't Cut Off Unemployment Benefits Now, ran yesterday, June 8th, in the Wall Street Journal. He will share his insights on the fiscal stimulus outlook. And Bill Dudley, Senior Research Scholar at the Griswold Center for Economic Policy Studies and former President of the Federal Reserve Bank of New York. Bill will share his perspectives on the monetary policy implications of COVID-19. Each of our presenters will speak for 10 to 15 minutes, and we will then turn to Q&A. You're welcome to submit questions at any time by clicking on the Zoom Q&A feature located at the bottom of the Zoom window. You can also upvote any questions you would like to see answered. We will try to get to as many questions as we can in the time we have following the initial presentations. A full recording of the talk will be posted on the Griswold Center's website and later this week on A Second Opinion podcast, which you can find on Apple Podcasts, on Spotify, and YouTube. The program. As we are all acutely aware, either from personal experience or the experience of friends, family, neighbors, and colleagues, this pandemic is perhaps equal parts deadly and financially devastating. Globally, there are over 7 million confirmed cases and 400,000 deaths from COVID-19. New daily cases hit a record high of 136,000 on Sunday, indicating that the pandemic appears to be worsening globally. The WHO urged countries that had seen improvement to remain vigilant. In the US, we have nearly 2 million confirmed cases and over 110,000 deaths, killing more Americans than the Vietnam War and the Korean War, and soon to surpass American lives lost in World War I. Communities of color are being hit disproportionately hard, with African American deaths nearly 2 times greater than would be expected based on their share of the population. On Monday, the National Bureau of Economic Research confirmed what we've all known, that the US economy entered a recession in February, marking the end of the 128-month expansion that began in June 2009. Last week, President Trump heralded the latest jobs report as a sign that the US economy is now rebounding like a rocket ship. Today's presenters will shed some light on what the latest economic indicators mean, whether the president's optimism is warranted, and we'll talk about why. With new domestic cases slowing and states reopening, we could still be in for a second wave of infection. And now let me turn to our first discussant, Jessica Metcalf.
Thanks very much. So I'm going to give you an epidemiological perspective on the state of the pandemic. Last time we spoke, I introduced 2 key quantities that epidemiologists use to describe early spread of a pandemic, one of which was R0, the number of secondary cases per infected individual, and the other of which was the serial interval, so the time that separates one case from the next. And with an R0 of 2 and an serial interval of about a week, what you expect is that cases will double every week. For this pathogen, we think that R0 might be slightly more than 2 in the absence of control efforts, and the serial interval might be somewhere around a week. And the result will be the exponential growth shown on the left, and that is indeed what we have observed the last time we spoke together around April 15th. On the top of this plot is deaths through time in a few different countries, and on the lower plot is cases through time. There's a few important things to note when looking at these sorts of graphs. One is which is, of course, there is tremendous issues around testing and estimating case numbers, and even deaths can be uncertain. But the other really critical point is that everything that we're seeing reflects actions taken 2 to 3 weeks in the past. As we moved past that April 15th point, where things still looked like everywhere was increasing in cases, the curves have flattened. So the cumulative numbers of cases were saturated in many, many places in the world, including the countries depicted here. And it's appropriate in this case to move from a cumulative case perspective to looking at daily cases. And if you do that, as shown here, what you see is that deaths are beginning to slightly fall in most places and cases are clearly falling in many settings. Germany has been doing extraordinarily well. Canada has been doing quite well. Other places are doing less well. And we all know that things are, of course, opening up. So the question then is, where are we now? Can we understand where we are in this context of this pandemic? Is it the beginning of the end? What can we expect for what the future holds? And I think I have to tell you that I think this is the beginning. And I think it's the beginning because most of the world is still susceptible. We know this because we have measures of what's known as serology or seropositivity within populations. This is slightly different from the estimates that are used to confirm cases. If you were to test me right now for COVID-19 active virus, I would probably test negative. I don't think I'm infected, but it would also only tell you about me right now. If, on the other hand, you were to take my blood and to do a serological test, what you'd find out is not only some indication of my infection in the previous weeks, but my infection all the way back through time. We think it's a reasonable marker of ever having been infected. So it gives us a window that integrates across the past and gives us a sense of who has been infected that encompasses, for example, the fact that it seems that many people who are infected by this infection show very mild symptoms. The proportion susceptible also gives us a sense of who is still susceptible, which means how much the outbreak could grow. And at the moment, estimates range around 2% in most settings, and only very large urban settings like New York have estimates of seropositivity of around 20%, indicating that 20% of the population might have been infected. So I think this is the beginning. It might be the end of the beginning, but it's definitely still very early on in this outbreak. Most of the world is still susceptible. Most of the world is still thus at risk of being infected. People have spoken of looking to climate to see if this will help as we move forwards. Coronaviruses are indeed winter pathogens, coronaviruses to which this particular pandemic virus belongs. And that means that if you were to draw a cartoon of what you expect for thy dynamics, you would expect an outbreak happening every year round about those gray bars that I've shown on this cartoon, which indicate winter. The drivers of this, the mechanisms underpinning this, are likely to be something to do with how lower transmission, or lower temperatures or lower humidity increase transmission, so shift how the virus moves from one person to another. The issue is that this is what happens in the endemic situation where the virus is moving from one year to another. If you modify this cartoon, this tiny simulation just a little bit to assume that the whole world is susceptible, what you can get is something like this. So that first peak is where I did exactly what I was doing in all the other years, except that I assumed that the whole of the population of the world was susceptible, of my world, my cartoon world. And what you get is this enormous peak because the number of cases that you get is a product of the fraction of the population that is susceptible to infection times transmission. So although climate might move the magnitude of transmission around, the magnitude of these changes is very, very small when confronted with a huge size of the susceptible population. I've done it in cartoon form here, but a brilliant postdoc at Princeton, Rachel Baker, looked across everything we know about how different directly transmitted winter viral pathogens transmission is modulated by climate, and put that together with global estimates of climate patterns, including humidity and temperature, and projected what we expect the outbreak to look like in cities all around the world. And what you find is that you see very little differentiation in the simplest analysis by climate reducing transmission over time. There's just so many susceptibles that that pattern is overwhelmed. You might, another really interesting point when you start thinking about what control efforts do to this pathogen, and the kind of flip side of this issue where susceptibles drive huge peaks, is that other infections are showing declines in incidence through time. So anything that requires direct contact between individuals to transmit is obviously transmitting less as we are all under lockdown. And you see this evidence, for example, here is a pattern showing a respiratory syncytial virus, which is a virus which kills 5% of children under 5 in the United States, falling through time. So previous years are shown in gray on this plot, and 2020 is shown in red. And following the declaration of a national emergency, so shown by that vertical line, incidence of 2020 RSV was much lower than had ever been previously experienced. And you see this in all the states across the United States, and you see it for both respiratory syncytial virus, but also for influenza. And it's no surprise, but again, work by Rachel Baker suggests that this is something to think about as we move forwards, because if you were to model this very simply, so you map the incidence there shown in the bottom set of curves, and translate that into susceptibles, the top set of curves shows fluctuations in the proportion of the population that is susceptible, and add on a time where non-pharmaceutical interventions are in place, what you see is that susceptibles will increase, which means that as we move forwards in time, you can actually end up having very large outbreaks, as everyone who wasn't infected during this period of lockdown is still vulnerable. So this is to keep an eye on the future, and we should always keep an eye on the future, but of course the near future is much more of concern right now. And just to come back to those initial slides, I think we can absolutely say that interventions have flattened the curve as we had originally intended to do. And this has brought really critical time to build knowledge about this virus in order to better protect ourselves from it. One of the things that we've learned is that it seems that pre-symptomatic transmission seems to be an incredibly important part of transmission dynamics, with various estimates ranging from around 40% of transmission, onward transmission, being driven by individuals in the few days before they start showing symptoms. Super spreading events seem to be very important for transmission of these pathogens. Most people seem to result in no onward transmission, most infected individuals, whereas a few are resulting in many, many individuals being infected. We understand a little bit more about how airflow might shape the transmission of this virus. And of course, and critically, we've bought time for the development of therapeutics and for development of vaccines, which has been happening at an extraordinary and unprecedented rate. But we also know, as Senator Frist referred to, that the interventions that we have in place are costly, and they're costly economically, and they're costly psychologically. And it's hard to imagine that we could maintain the sorts of policies we have in place much further into the future. And the policies that have been implemented have been, for example, social distancing encouraged, public events banned, school closures, and lockdowns, all the way through to lockdowns. An interesting point is that these different interventions are differentially costly and might very well be differentially effective in reducing transmission. And as we move forwards, and as more and more places release various restrictions placed upon populations, it would be most effective to relax the ones that are the least effective and the most costly. The issue is that we don't know which those are right now. And I think one of the really interesting questions, and particularly as many places move forwards to release lockdowns, is to think about how we can evaluate these policies. And in this situation, the very speed of the virus is kind of on our side. So by delaying opening some settings just by a couple of weeks and monitoring very closely how cases change through times and how susceptibles change through times, we could gain an awful lot of information about how that particular intervention modulated transmission in that context. So for example, we could open schools earlier in one set of locations and open them just a week later in another set of locations and learn a lot more about how transmission was being altered in the setting. And I think obviously everywhere is opening up come what may, but it is an incredible loss if we squander the opportunity to learn about what works in these settings. And I think this should be an important part of the agenda going forwards. So just to conclude, I think this is the beginning. Most of the world is still susceptible to a highly transmissible and lethal pathogen. We also know that this lockdown in place in many settings is just not sustainable. I think that you can absolutely say that everything we did in the early phases was very sensible. The precautionary principle was required since we knew so little about what was going on, but now we need data to try and understand which interventions work and how. I think the evidence will come from many sources, and we're building our understanding of what's going on from trials to models probing transmission dynamics. And certainly all the time we earn is time where we learn, and that is incredibly important. But I think we should also be mindful of not squandering those opportunities. And I think that international collaboration on drug and vaccine development and deployment is really important as we go forwards as well. So that's all I have.
Good, Jessica, thank you for that tremendous overview and look ahead. It answered a lot of the questions that I had, but also stimulated a lot of questions we'll come back to here. And again, people feel free to come in on the Q&A and we'll get to your questions shortly. With that, let's turn to Alan Blinder to share his insights on the fiscal stimulus outlook. Alan?
All right, I'm attempting to share the screen, I think. That good?
That's good.
Okay. So we were reconvened here on April 2nd, at which point we knew almost nothing about what the pandemic was going to do to the economy, except that it would be bad. Now we know a little bit. We still have a lot that we don't know. So I want to start with that. So there are two slides on the shape of the recession, and let's be optimistic and think about the recovery. This one has to do with unemployment. As probably most everybody on this webinar knows, the May employment report that came out in early June was a shocker. Even the super optimists in the administration that have been trying to put the best possible face on everything were surprised by this. The surprise is not that it turned up. We weren't going to keep losing millions and millions of jobs every month indefinitely, but that it turned up so quickly. For those of you who aren't aficionados, the monthly employment reports are done during the week that includes the 12th of the month. So think of this as the situation on May 12th. When we got into early June, I never thought the situation on May 12th would show an increase in hiring, never mind 2.5 million, but an increase at all. So the big surprise was how quickly we went from net firing to net layoffs rather to net hiring. There's a quirk in the numbers that is worth talking about briefly. At the bottom of that slide, you see what happened February, March, April, May. These are the official unemployment readings from the Bureau of Labor Statistics. And I note there that the highest number we had ever seen since the 1930s prior to last month was 10.8. Everybody has problems making things work as normal under the conditions we're operating under now. That includes the survey takers that help the Bureau of Labor Statistics produce their numbers. In both the April and May reports, the BLS noted in the press release that they believe there was a significant misclassification into the catch-all category employed other that shouldn't have been there, and many of those people were in fact unemployed. So the upshot of that is that 14.7 number is probably too low, the BLS thinks, by maybe 3 percentage points or more, and the 13.3% number is also too low. But, and this is the important point, and the reason I started the slide where I did, this undercount of the unemployed, if that's what it is, that's what we think it is, was larger in April than in May. They fixed it a little bit. And so the delta, the change in the unemployment rate, if better measured, was probably even more than the 1.4 percentage points that you see on the screen. So that's good news. Looking at real GDP instead of unemployment, these are some round numbers, always at annual rates for the first and second quarters of this year, and an estimate from the CBO made a couple of weeks ago of the second half of this year, the beginnings of the recovery. So It's a little tricky to look at these. These are annualized rates, and that's why I wrote in the margin, so to speak, the level. So when we say in the first quarter, we have data, although it'll be revised, that the economy declined 5% at an annual rate. That means the level of GDP dropped about 1.3%. And an important PS is all of this, sorry, more than all of this happened in March. There's very little doubt that January and February were up months. March was a catastrophe, enough of a catastrophe to make the annualized rate for the 3-month period, January, February, March, negative 5%. Q2 is the quarter we're living in right now. It's nearly ending by the calendar, but not by the data. The data come in with a lag. There are guesses all over the map. -30 to -40 is where you find most of them, although some people are mindful of the fact that we're likely to have very big data revisions because of the general chaos. If I use -40% as a guesstimate, that will mean that in the second quarter, in this quarter, the level of GDP falls 12%. Add that to 1.3 from the previous, and you got a 13.3% decline in the level of GDP, getting less than half of that back in the second half of the year. And I put at the bottom of this slide, just to put that 13.3% down on the level into some context, in what we've been calling the Great Recession, the level of GDP at maximum fell 4%. And we thought that was a whopping big recession. And going back to the Great Depression, where we only have annual data, the decline, and it took 4 years, was 26.5. So in roughly speaking, we have had already, this is June, a decline in the level of GDP, about half of what happened in the Great Depression, and that happened in about 4 or 5 months, as opposed to 4 years. So this is a whopper. A few oddities about this recession. The first one is what I was just been speaking about, the incredible speed. Recessions never happen this fast, but this one did, for fairly obvious reasons. Recessions since the Great Depression have never gone anywhere close to as deep as this one has already gone. And we're not finished looking at the data. An oddity, another oddity of this recession compared to others is that it's showing up so strongly. The leading sector pulling us down is consumer spending on services, which in normal times, I didn't go back and check, I think it's probably true of every post-war recession, has been the least cyclical component of spending. It's not consumer services that go down, it's business investment, consumer durables, automobiles, housing, things like that. They have gone down also, but the lead going down has been consumer services, leisure, hospitality, restaurants, and so on. I don't believe we've ever seen that before. And by the way, that was the leading sector that dipped up in May in the employment report. A lot of jobs came back in those severely impacted sectors. The other very, very unusual, and again, I think unprecedented aspect of this recession is that because of the gigantic volume of government transfer payments to the unemployed, to people in general, and in other ways, disposable personal income has actually gone up while the economy's tanking. So if you think of what that means, people aren't spending, production is down, but checks are coming from the government. People aren't spending, they're spending some of those checks, but a lot of them are saving. And presumably that will get spent as the economy starts to renormalize. But it's a testament to the scale of the government interventions that the basic measure of disposable personal income has gone up, not down, despite the worst recession since the 1930s. Needless to say, we didn't do anything like that in the 1930s. This slide is about fiscal stimulus, and I put the word stimulus in quotes for a reason, which will be, well, you see the second bullet point, I'll come to that. As I was just saying, the fiscal support from the federal government, largely in the form of transfer payments, has been enormous on a scale that we've never seen before. And incidentally, as a share of GDP, what the US government has done is roughly the biggest in the world. If you look at, all governments are doing things like this, but as a share of GDP, we're leading the pack. That is unusual for the United States of America. That was not true in the Great Recession by a long shot. A number of other countries did more to try to cushion the blow than we have, but we have done an enormous amount already. And I'm going to come in a minute to the need for another bill, but nobody can accuse the federal government of being slackers. There's lots of places where the federal government could confuse them not getting it quite right, and this could have been done better and differently and so on. That's all legitimate. But in terms of magnitude, it's been a very big effort. Now, as it says on this middle bullet point, it is wrong to think of this as stimulus. The right way to think of this as emergency relief. So when a hurricane hits New Orleans or Houston or wherever, or Florida, wherever it hits, money, people, resources pour in to try to, in some sense, literally keep people afloat. Starts by not letting people drown, and then keeping them fed and clothed and with water and so on to reduce the horrific cost of the hurricane. Nobody thinks of those nobody thought of those expenditures in Florida and New Orleans and Houston as economic stimulus to try to make the economy grow faster. That's not what they were. And that's not what the actions of Congress have been so far. But once the economy gets back on its feet, conventional economic stimuli will be needed, I believe, and will help to boost demand as they have in the past. That's both fiscal stimulus and monetary stimulus, which I'm leaving to Bill Dudley in the next segment. So that's an important conceptual difference, which leads naturally to the thinking about the second half recovery. You saw a couple of slides ago, the CBO's forecast of a few weeks ago had a very large growth rate for the second half coming off the very, very deep bottom. And the point of the first bullet point here is as the economy starts to normalize, so people get out of their shells, start going back to stores, restaurants, whatever they're going to do, conventional stimulus will start to matter because people will be willing and able to spend money. That said, the shape of this recovery is going to depend sensitively on the pandemic. This bullet point, by the way, is one thing I do remember saying at our first meeting. It's pretty obvious. The pandemic is leading the way. If there's a second wave, all bets are off. So you saw that CBO number a few slides back, 16% annualized growth rate in the second half. If we get a second wave of the pandemic, we're not getting anything like that. And I think if it's really a serious second wave, that forecast will go negative, not positive. It's worth remembering, though not a very happy memory, that the so-called Spanish flu of a century ago came in 3 waves. And in fact, the second wave was the worst. 2 waves in 1918, 1 wave in 1919. By the way, just as a footnote, the little bit of good news in that is as best we can tell, now we don't have great data for 1918, the economy was not that badly set back by the Spanish flu. That's amazing, and I'm not a good enough historian to tell you more about why. Except the obvious point that the service sector was a lot smaller than it is today. But so the bad news is Spanish flu came in 3 waves. That's very bad news. If we get that again, it's going to be horrific. The good news is it didn't kill the economy. A point that's worth making that you see made sometimes, but not always, especially among people that want to blame the government shutdowns for all of the economic travails, is that people were withdrawing from one another even before the states ordered them to. This next sub-bullet is not about states in the United States, but you can see this in restaurant bookings, retail sales, and these things that Unicast and others get from cell phone mobility and things like that. People were withdrawing out of fear from one another before their state governments put them in lockdown or semi-lockdown or ever. I believe the converse will be many people will stay withdrawn even as the states say it's okay to go to the dentist. I was actually on a conference the other day with a guy who went to his dentist. I couldn't believe my ears that he actually went to the dentist, but he did. But I'm not going to the dentist for a while, I can assure you of that. An interesting thing that came across my email a couple of weeks ago was the comparison between Denmark and Sweden. Sweden, as probably everybody knows, allegedly went for herd immunity, didn't order any lockdowns, the restaurants stayed open and so on. Denmark didn't. And if you look, this was as of a couple of weeks ago, at the drop in consumer spending between those two countries, Denmark's was only about 4% bigger than Sweden's. So it's not like every Swede thought happy days are here again. They were worried and they did social distance and they did stay away. They weren't ordered to. That was voluntary responses by Swedish citizens. Okay, finally, we need another bill soon. As was implicit or explicit in what I said before, this next big bill ought to combine elements of relief. We're not finished with that, but also elements of stimulus, trying to get the economy out of this big hole as we go. The 2 biggest needs are the next 2 major bullet points. I'll just take a minute or so on each. There's a gigantic need now for assistance to state and local governments. If you think about where the burden of the spending on healthcare, equipment, et cetera, has come, it's fallen on the state and local governments, not on the federal governments. Which, I think it would be unkind to say the federal government was hiding in the corner. That's an exaggeration. But the effort and the expenditure was minor compared to the burden on state and local governments. And the revenues are falling off a cliff. A lot of them rely heavily, most of them, on sales taxes. And when you don't have sales, you don't have sales tax receipts. So a horrible consequence of this is, if you look at the details of the last few employment reports, state and local governments are cutting jobs like mad. We don't need that for normal cyclical reasons, and we definitely don't need that for pandemic reasons. These are the people that are helping fight the pandemic. Very sadly, this idea that we need to send more money from the federal government to state and local governments has become yet another red-blue issue. It is sad and horrifying that that is happening, but it is happening, and it's going to be a big bone of contention when Congress gets down to legislating the next big package. The second issue is the one that Senator Frist referred to my Wall Street Journal piece about unemployment insurance. He said it was in yesterday's paper. If you actually look at physical paper, it's in today's. It came up online yesterday. I'm reading online these days. The emergency provisions having to do with unemployment insurance in the CARES Act were written to expire at the end of July. There is now a debate going on with many Democrats, and this is in the HEROES Act, expanding them as is, saying July 31st is too soon, we got to keep this up. That means, among other things, that the fixed $600 per week extra payment by the federal government, remember these are state programs, but the federal government is now kicking in several things, including an extra $600 a week. For 2/3 of the unemployed, that is more than they got when they were on the job. And as we start to open up, that's a serious work disincentive, which we didn't worry about when people were told to stay home and don't go to work. A number of Republicans have been vocal about just stopping the extra benefit that's in the CARES Act, which I think would be a catastrophic error. Remember, I mean, nobody knows, but at the end of July, the unemployment rate's going to be, pick a number, 12, 13, 14%, greater than it's been in any month except the recent months since the 1930s. It's hard to imagine a worse time to zero out the extra benefits. So what needs to be done is some restructuring. The $600 a week fixed number probably never made sense at the beginning. The Congress rushed it, it did that. There are sensible alternatives, such as, for example, raising the replacement rate by a uniform percentage across states. So in my Wall Street Journal piece, as an example, I said states that only pay 35% typically of lost wages could pay 75% with the extra 40% covered by the feds. And states that pay 50% normally could go up to 90%, same 40 percentage points. But you get away from this problem of having 2/3 of the people lose money if they actually leave the unemployment rate and go back to work. This is another place where I fear we're already in and heading for worse of a really partisan debate. As I said, the HEROES Act has it extending the 600 as it is. The Republicans seem dead set against that. On the other side, the Republicans are very insistent on liability protection for businesses, which may make sense depending on how you do it, but Democrats are very skeptical about that. So we're in for a partisan debate. Last remark in 30 seconds. People ask a lot about the skyrocketing federal debt. It is skyrocketing in just a few months. But so far, most of it has been bought by the Fed, which is one of the natural lead-ins to Bill Dudley coming next. One of the things we're going to learn in the coming months, but I think more years, is how very large the appetite in world capital markets is for US federal government debt. It's obviously gigantic, but that's an imprecise number. Is it 5 trillion, 20 trillion? I mean, is there a limit at all? We're not close to testing that limit now, but as time goes by, we may start testing it. Thank you. And I'm going to stop sharing mine to make room, right?
Good, Alan, thank you very much. And that's a perfect transition to Bill Dudley. Bill, a little bit on the monetary policy.
I'm going to talk about three things. One, what the Fed has accomplished up to now. Two, what's next? What are they going to be talking about at the FOMC meeting, which is taking place as we speak right now? And three, talk about some of the longer term challenges that they face. So what has the Fed accomplished so far? Well, I think they've accomplished quite a bit. The first thing they've accomplished is they've restored market function. In the early days of the pandemic, markets basically broke down. Even the US Treasury market wasn't functioning very well. The problem was that there were a lot of hedge funds that had bought cash treasuries and gone short Treasury futures and leveraged these positions up 50, 60, 70 to 1. When volatility in the market picked up, they could no longer hold these cash treasuries and they had to disgorge them into the market. There was no buyers on the other side. The primary dealers didn't have a big enough balance sheet to take this on. And so the Fed basically rushed into the market and started to buy just incredibly large amounts of treasury securities. At one point, it was $75 billion of treasury purchases per a day. So the Fed's Treasury purchases so far have climbed by about $2 trillion. So that's from 2 trillion of holdings to 4 trillion of holdings just in a few months. And that has actually restored market functioning to the US Treasury market. The second thing the Fed has done that's been quite successful is they've actually stood up a whole number of special liquidity facilities to backstop financial markets. Commercial paper funding facility, corporate bond facilities, and a facility to purchase municipal securities. And these have actually made these markets work. Companies that are highly leveraged can actually go into the marketplace and obtain funds. This would not have been the case if the Fed had not offered a credible backstop. And what's interesting about it is the Fed hasn't had to do very much. So just the ability of the Fed to be a backstop has actually encouraged people in the marketplace to participate. And so the Federal Reserve actually hasn't had to buy too much. So this has been quite impressive. As a consequence of the Fed's actions, the big widening we saw in credit spreads has come in. I'll just give you some numbers for one of the big high yield ETFs called JNK. It was about 110 in price early in the year. It fell all the way to 85 as spreads widened dramatically in March, back to 107. So basically about 90% of the decline in the high yield debt market has been reversed, partly due to the Fed's interventions. The second thing the Fed's been very successful in as part of this is it's made financial conditions much more accommodative. Credit spreads have narrowed, the stock market has risen significantly, and so the financial markets generally are actually quite supportive to economic activity. So from the Fed's perspective, as they sit there today at the FOMC meeting, they have to feel pretty comfortable, pretty good about what they've accomplished at this point. So what's next? Well, the first thing that's next is they have to think about how are they going to transition in terms of their asset purchases. The asset purchases initially were about restoring market function, but now the Fed is actually transitioning to making asset purchases not to restore market functioning, but to hold down long-term bond yields. They want to keep long-term bond yields low to support the US economy. They haven't really said yet exactly how they're going to make this transition. They haven't said exactly how many Treasury securities and agency mortgage-backed securities they're going to continue to buy, but it's likely to be a pretty, healthy clip. During the great financial crisis, the Fed at its peak was buying 45 billion of Treasuries a month and 40 billion of agency mortgage-backed securities a month. Currently, the Fed's doing more than that, 85 to 90 billion of Treasuries a month, 95 billion of agency MBS a month. So I think that they're probably going to continue to rate somewhat above what they saw during the great financial crisis for two reasons. One, the economy is bigger now than then. And two, the Treasury's financing needs, as Alan Blinder pointed out, are much greater. And so if the Fed purchases more securities, they can probably have more favorable effects in terms of holding down Treasury bond yields. Second thing they're going to be working on is what guidance should they give the market about the future course of US monetary policy? How long are short-term interest rates going to be kept at zero or close to zero? They could specify forward guidance in terms of time. We're going to keep short-term rates low for 2 years, 3 years, 4 years, or they could provide forward guidance in terms of conditions. We're going to keep short-term rates at zero until the unemployment rate falls below, say, 5.5%, or inflation rises above 2%. And so they're discussing exactly how they want to communicate about not what monetary policy is today, but how it's likely to evolve in the future. This is something that they actually have a little bit of time to work out, because market anticipating any moves from the Fed in the near future. If you look at Eurodollar futures, it's a market that extends out about 6 years. And right now, 5 years from now, Eurodollar futures market still has short-term interest rates below 1%. So the Fed doesn't have any problem right now with people thinking that they're going to tighten monetary policy quickly. The market expects the Fed to be friendly for a long time. So forward guidance can be done more deliberately because there's not any disagreement between the Fed and the markets. The third issue that they're going to be taking up is so-called yield curve control. Yield curve control is when a central bank basically says, we're going to peg a level of Treasury yields at a particular level. Japan has been doing this for the 10-year JGB yield for a number of years. And so why would you commit to pegging the interest rate level for treasuries? Well, you might do it for two reasons. One, it reinforces forward guidance. People will be more confident that you actually mean what you say about keeping short-term rates low. You've also reinforced it by a commitment to actually peg medium-term interest rates. And also, if you're actually credible in your commitment to yield curve control, you might not actually have to purchase as much Treasury securities to accomplish your goals. If everybody views your commitment as credible, they'll buy the securities because they're not going to have a lot of risk because the yields are going to be very, very stable. Doesn't seem that the Fed is in a rush here either in terms of yield curve control. And I think there's a couple of reasons for that. Number one, the uncertainty level about the outlook is very high because we really don't know how the pandemic is going to unfold. And there's really no problem right now because Treasury yields are very, very low. But this is something that they're going to definitely be talking about. The third issue that people ask about a lot that's not going to be forthcoming is Fed moving to negative short-term interest rates. The Fed has essentially taken this off the table for a number of reasons. Number one, you can't go that negative. Number two, it actually makes the banking system less profitable and so therefore impedes the ability of the banking system to support the economy. Number three, in the United States, it basically would put your money markets out of business. And most importantly, when you said that you're not going to do it, if you actually were to finally do it, it would not be confidence enhancing. If the Fed were actually to go forward with negative interest rates at this point, people would basically conclude that the Fed was more pessimistic about the outlook, had less good monetary policy tools available, and it would probably actually be counterproductive in making people feel more confident about the economic outlook. Lastly, the Fed's in the process of having to operationalize a lot of complex programs. And the one that's probably the most novel and most difficult is the Main Street Lending Program. This is a program in which the Fed is trying to provide loans to medium and larger businesses that aren't so big that they can actually access the capital markets directly, but businesses that have hundreds and maybe even thousands of employees. Under the Main Street Lending Program, how it's supposed to work is a bank is supposed to basically make a loan to a business, keep 5% of the loan on its books, and have the rest of the loan be transferred to the Treasury, a 95% participation rate by the Treasury. This is going to be a program that's going to be very difficult to get right. If the terms of the loan are too easy, the Fed's going to get stuck with a lot of bad loans. And you can certainly imagine a situation where banks might lend to clients that aren't very healthy, because if I give them $100 and I only take 5% of the risk, that $100 may buy me a lot of time. And I may get paid a lot back in terms of the other loans that I have outstanding to this entity. There's also the risk that the terms might be too tough. Already there's some question about whether businesses actually want to participate in the Main Street Lending Program because they're worried that there might be strings attached that might make the program less attractive. Finally, with the Main Street Lending Program, it only operates through depository institutions. And so there's some questions about what happens to borrowers that borrow not from banks, but from non-banks. How will they be able to access this facility? This program, the Main Street Lending Facility, is unlike anything that was done during the last financial crisis. It's not a market backstop. It's the Fed essentially providing balance sheet capacity in terms of lending to corporations that it views that the banking system may not have sufficient capacity. So we're going to have to see how that all turns out. Challenges for the Fed. Well, the first challenge, of course, is there are the concerns about the rapid growth in the Fed's balance sheet. The balance sheet is now more than $7 trillion in size, and probably by the time we get to the end of the year, will be 9 to 10 trillion in magnitude. This compares to a peak during the great financial crisis of about 4.5 trillion. And so the worries will be the same worries that we had then. Will it be inflationary? I don't think there's much risk of it being inflationary as long as the Fed does its job. The Fed can control the demand for credit by raising the interest rate it pays on excess reserves if it sees that the economy is overheating. But there will be a lot of discussion and anxiety about the rapid growth of the Fed's balance sheet. Second challenge for the Fed's actions by intervening so aggressively in financial markets, they've driven up financial asset prices. And by driving up financial asset prices, that has benefited people who hold financial assets, people who are wealthy, relative to people that are poor. So the Fed actions are seen as exacerbating inequality in the United States. Unfortunately, there's not much the Fed can do about this, given that the tools that it has available. Frankly, it can't easily operationalize programs that reach out to millions of households or millions of small businesses. So the Fed is basically faced with a choice that's an unpleasant choice. One, stimulate the economy by making markets work, by making financial conditions more accommodative. That will exacerbate inequality, but it will also generate a stronger economy. Or decide not to do this, to be more worried about inequality. But if the Fed doesn't act, what you'd end up with is less inequality, but a weaker economy, higher unemployment, and lots of innocent middle class and lower income households would be hurt by the Fed's inaction. Finally, the Fed has a problem of communications. The Fed can't control the pandemic. It can't fill the income holes created by social distancing or the balance sheet damage that we've seen for households and businesses. So there is a risk of disappointment as the economic recovery unfolds. If the recovery is slower than anticipated, or a second wave leads to renewed social distancing, the Federal Reserve, there's not that much more that the Federal Reserve can do. And so I think people right now are a little bit more optimistic about what the Fed has up its sleeve than the tools that it actually has available. And then finally, lastly, in terms of challenges, the Fed's actions, which I think have been completely appropriate, have bailed out a lot of people that took on risk. So hedge funds that were highly invested in treasuries in a leveraged trade, long treasuries cash, short treasuries futures, were bailed out by the Fed's treasury purchases. Mortgage REITs that were long agency mortgage-backed securities were bailed out by the Fed's agency mortgage-backed securities purchases. Junk bond investors have been aided by the Fed's corporate bond purchase program. Highly leveraged companies have also been helped. And of course, that increases the risk for excessive risk-taking in the future, unfortunately. If every time we have a financial crisis, the Fed intervenes very aggressively, that will basically socialize some of the risk. And that will encourage people next cycle to take on more risk, which will then create more incentives for the Fed to intervene aggressively. The Federal Reserve, it's not easy to deal with moral hazard in the middle of a financial crisis, and probably you don't want to deal with moral hazard in the middle of financial crisis. If you don't provide support, you're going to end up with many innocent victims. Not intervening to teach people a lesson is not really worth the cost of depression. But there are reputational consequences of the Fed for bailing out, a good portion of Wall Street. And so this is something I think the Federal Reserve needs to speak to and address. So that's one of the important communications challenges of the Fed. Thank you.
Good, Bill. Thanks. Thanks a million. That's superb. Now we're going to turn to our Q&A portion of our event. If you haven't already, please go ahead and submit questions. We've got a whole bunch of questions to get to. But click on, remember, Zoom Q&A feature. It's at the bottom of your Zoom window. And let's start with a couple of questions, tying things together a bit. And Jess, the first one is going to be for you and ties in a list. I'll go to the question, but Alan said, if there's a second wave, all bets are off. Now, he was talking specifically about economic and the recovery phase, but it leads me into the first question from Ilyana Kuziemko, who says, what are the chances of a second wave? And do we have reason to believe that it could be like 1918, 1919, where, as we all know, the second wave was much worse than the first? Yes?
So that's a great question. To start with, to come back to something I said in the presentation, everybody is still susceptible. So if you were to stop all control measures right now, you would get a second wave. It's very hard to predict what the human behavior, human policy aspect will be and how that will modulate cases over the coming months. The second wave in influenza, I think I'm not entirely sure that we've completely got to the bottom of it, but there was certainly suggestion that this was associated with evolution of the virus. I don't think we have any reason to believe or any evidence to date that there has been any selection on this virus to change its virulence properties or its transmission properties. There is certainly a spread of different mutations in different parts of the world, but it's important to remember that mutation is something that happens all the time. It's just like spelling mistakes. So the fact that there are particular mutations in particular places doesn't tell us anything more than the fact that this is a virus that is spreading around the world. You'd expect strong selection if there was an association between virulence and transmission. So if it made you feel worse, it also transmitted better. There seems to be such erratic relationships between viral titers and symptoms that I don't think there's any reason to particularly anticipate that. And also this virus seems to be doing really very well at getting around the world as it is. So I don't think the selection pressure is likely to be strong. So I think the answer it depends on how you define a second wave. Most of the world is still susceptible. It will hinge on policy responses and human behavior aspects.
And Jessica, with your comments earlier in your opening remarks, do you expect there to be an increase in the fall, or as things do cool, humidity changes?
I do think there is reason to think that seasonal forces might modulate the transmission of this virus a little bit. I still think that under most of the sets of contexts that we're thinking about, this will be a very small effect relative to the effect that most of the population is susceptible. So it is possible that it might play a role if we had tamped transmission down hard enough that it became an important force, but I think most of the evidence suggests that it's unlikely to play a role, at least in the coming fall. It might be relevant further down the line. I think that, absent a vaccine, the expectation is based on previous influenza viruses is that this will settle down to become an endemic infection, right? Where we have an outbreak every winter that hinges on depletes susceptibles and falls away and depletes susceptibles and falls away. But before then, I think we're still in the phase where the huge size of the susceptible pool dominates the dynamics.
Okay, good. Thank you. Next question, Torsten Slock. If the unemployment rate stays elevated for the next 6 months, as the CBO currently expects, what does that mean for households' ability to pay their auto loans, credit card loans, and mortgages? If there's significant risk of consumer loan delinquency rates going up, does that mean that more fiscal stimulus is likely to be needed to prevent a significant rise in insolvencies in the household sector?
I think that was for me. I think the short answer, Torsten, is yes. It's one of the reasons that I emphasized towards the end of my presentation, the need for another bill that combines elements of relief and elements of stimulus. The kinds of things you're pointing to are sort of right in the intersection of relief and stimulus. The good news, as you know, is that a lot of money got saved, still is getting saved because of the tremendous flow of transfer payments and relative to low levels of consumer spending. And I think I'm sure that's one of the reasons that we haven't seen a big surge of delinquencies and bankruptcies yet. But, to your question, if we get a second wave, that's part of what I meant by all bets are off. I mean, this is a political economy guess. I'm not completely confident that the Congress will step up to the plate in sufficient magnitude again. They did in March with the CARES Act. I'm just worried that they won't if we need a second, I'll call a second CARES Act. It won't be the CARES Act. It won't be exactly the same thing, but I just worry that they won't, and the states and never mind the localities, but the states are not fiscally capable of filling the void.
Good. Thank you. Next question up from Johnny B to Bill Dudley. The Fed's balance has climbed by more than $3 trillion this year to over $7 trillion. How nervous should we be about this? What risk is the Fed taking with its balance sheet? Bill?
Well, people are most worried about that the balance sheet expansion is somehow monetizing the debt, and that's going to cause a great inflation down the road. We had that same worry following the great financial crisis, and that worry didn't pan out. And the reason why that worry didn't pan out is the Federal Reserve has a way of modulating the expansion of credit, not through the size of the balance sheet, but through the interest rate it charged on excess reserves. So if the Fed sees credit creation occurring too rapidly and therefore the economy is starting to overheat, it has the ability, regardless of the size of the balance sheet, to raise short-term interest rates and slow the economy down. I think the balance sheet risks are actually a little bit more subtle. The biggest balance sheet risk is number one, that the Fed actually has a lot of interest rate risk in its portfolio. Most of the Fed's liabilities are overnight reserves, and most of the Fed's assets are longer treasuries and agency mortgage-backed securities. So the Fed is like a thrift, and that's fine if interest rates, short-term rates are low and longer-term rates are higher. But one can certainly imagine a situation down the road, if we actually do have a sustainable recovery 2, 3, 4, 5 years down the road, where the Fed will have to raise short-term rates a lot. And then the cost of the Fed's liabilities could potentially exceed the revenue of their assets. And the Fed, rather than making payments to the Treasury of its net excess earnings, would actually be losing money. People don't talk about this very much. It's probably not a near-term issue. But to me, that's the biggest risk of the Fed's balance sheet. Credit risks are really low. The Fed is basically owning treasuries, agency mortgage-backed securities. It's got a lot of money in terms of foreign exchange swaps to foreign central banks. That's very safe as well. The facilities that it's introduced, the special liquidity facilities, almost all of them are backstopped by the Treasury. So the US Treasury is taking the first loss piece. So from a credit risk perspective, I think the Fed's risks on its balance sheet are very low.
Good, thank you, Bill. We've got a number of questions coming in, and I'll summarize by taking one of them, and it really boils down to why in the world is the stock market doing so well. But let me read the question. The Dow has almost completely recovered from its February and March crashes. How is this consistent with predictions of huge declines in GDP and consumer demand, which you presented? One theory is that the Dow reflects larger companies, and COVID will actually benefit them because smaller companies are dying and thus larger firms will have more market power. What do you think of that theory? Or do you have other thoughts about why the market is doing so well while the country seems to be falling apart? Let's throw it over.
Well, I'm happy to take a shot at that. I mean, the stock market's always a forward discounting mechanism of what it anticipates, not today, but in the future. And in fact, if you look at most U.S. recessions, the stock market recovers long before the U.S. economy actually gets out of recession. So that's number one. Number two, the stocks market is relative to other financial assets, with the yield you can get on other financial assets. And with long-dated Treasury securities, 10-year Treasury securities yielding 1%, presumably people think, well, stocks look pretty good relative to earning 1% on a 10-year Treasury. Now, I think the issue for the stock market is really, is there a forecast of a sustainable economic recovery back close to where we were, a few months ago? Is that going to pan out or not? Is there going to be a second wave of the pandemic? And so where I would be a little bit more cautious myself, compared to where the stock market is I think that the uncertainty level right now is extraordinarily high. And I'm a little surprised that the stock market is not putting a little bit more weight just on how uncertain the economic outlook is.
Yeah, I agree with that very much. I want to just amplify where Bill finished and say just a couple of other quick things. It looks to me, look, I don't predict the stock market, only a fool does that. But it looks to me that the stock market is priced for the happy scenario, not for the unhappy scenario. So the happy scenario, which got fed by the May employment report is that this is a relatively quick recovery. The government and the Fed are in there making sure the worst doesn't happen. This sort of that leaves out the fact that the government can't control the virus or is doing a very bad job of controlling the virus, and interest rates are low, as Bill said, and so on and so forth. The two things that I would add to what Bill said, and I'm sure he doesn't disagree with this. If you look at a little more of the details of the market, I don't mean the real details, but a little, you see that the tech sector is doing better than the rest. So the NASDAQ, I think, Torsten's on the line, I think the NASDAQ is at its all-time high again or something like that. And it's being led by the tech giants. This has been a pretty good time to be Twitter, Amazon, Facebook, and so on. They're all doing very well. I did look the other day because I was curious, or I asked someone else to look who looked. The Russell 2000, which has a lot smaller companies than the S&P 500, not to mention the Dow 30, has lagged significantly behind the Dow and the S&P. So I think you said, Senator, about big companies, small companies. There is a rift between big, I don't mean tiny companies. The really tiny companies aren't on any stock market, but big companies and modest sized companies that the earnings are moving towards the big companies.
Good, thank you. Let's turn to another question, and we'll go back to the close to the clinical world, Jess, and it's on serology. And as a preface to the question, and the question reads, on serology, it seems to be so critical. Are there efforts to standardize and generalize collection of data? And just for our listeners, and I know just about everybody knows it, but there are two types of tests that are out there today, and you have to separate them two, and it's critical that you do. One is the PCR test. You take it, there's the nasopharyngeal sampling, and that's a yes, no, you have it or you don't. Then you have the serology test, which are blood tests, and they tell you whether you've had it in the past. And it can be in the near past or the distant past. And with that as sort of a background, Jessica, why don't you take the serology question?
So I think that's a great question. As I hope emerged from your lovely description, Senator Frist, and my presentation, was they give you two different types of information. And for the first, so for looking for active virus, you actually have to catch people while they're infected. And in fact, you can get false negatives during the first 5 days of infection. So it can give you a pretty incomplete picture, you know, quite apart from the fact that you have to go out and get everybody in order to get a sense of what the infection rates are. With serology, you get more information just because you're integrating across the past of every individual. What you're looking for in this blood sample is markers of past infection. So your immune system recognizing this particular bug. It would be incredibly powerful in giving us a window onto the rates, for example, of asymptomatic infection, the rates of infection that has occurred, the fraction of the population that is still susceptible, were standardized designs in sampling across populations in place. This is sadly not the case in the United States, to my knowledge to date, although there's many efforts in many settings underway. And many of these people do talk to each other and coordinate across each other. There's a little more coordination, for example, in Spain, do carefully designed randomized samples, and I think Britain is trying, and so on. But it could give us a really unparalleled window onto the landscape of immunity of the populations, which really defines how the pathogen can spread, both for this virus, but also for all other viruses. So it could be something you harnessed for looking more widely into our landscape of health. So I think it's a really important area for investment as we look to the future, because this is also unlikely to be the last pandemic, sadly.
Good, thank you. And I'll just add on the PCR test, you got it or you don't. The accuracy, the sensitivity, specificity has been very good. The serology test, the blood test that tells whether you've had it in the past, notoriously in the past month has had a lot of false positives, a lot of false negatives, have not been very accurate. And that's being improved and improved quickly today. And everybody wants to get all these tests, but I think it's important for our listeners to know that the accuracy of the serology tests in the United States, and in part it's because people rushed out with lots of different tests, but that's being corrected very quickly. One other, because a lot of questions are coming in, and it's on the vaccines themselves. I think as Alan has said, the course of the pandemic in large part will determine the course of the economy. And we're hanging a lot on the vaccine. We will be able to get a successful vaccine to this. Remember, some we can't, like HIV/AIDS today, we still don't have a vaccine after trying for 30 years. On the coronavirus, we will be able to get a vaccine. In fact, we have other coronavirus in the veterinary field vaccines, and so we're confident we can do it. Some questions have been, what kind of vaccines are there? There are basically three kinds of vaccine. One is what's called a viral vector vaccine, where you have a piece of a DNA to somebody and it's essentially dead, but then it takes the machinery over and creates the antibodies, the immune response. The second is a messenger RNA, which is a new type of vaccine that is a little bit harder, especially in transmission. If you have to send it, it has to be kept in a certain way. It's hard to transport a little more, but if you can manufacture it, you can manufacture it very quickly. So there are three of the vectors out there today that are being looked at, and about 3 or 4, and probably more, but 3 or 4 of the mRNA. And the third is a DNA vaccine as well. The issues about vaccine in terms of global distribution, manufacturing are just being looked at. We don't have all those answers. We know we don't have the manufacturing capacity in the United States of America. It is elsewhere, is outside of Amsterdam with certain companies, is in Brazil and in India, but we have to address that. And then who gets that vaccine at a point in time? It'll be a full year from now. The vaccine we'll have the vaccine sooner than that. But it will be for higher risk populations initially, healthcare people and others, number one, and highly vulnerable people. But number 2, we have to really approve the safety of it. Before you can give it to 7 billion people, you want to make sure that the side effects and the even death caused by a vaccine will not outweigh the benefits. So we have a long way to go with the vaccine. The antiviral agents also a lot of people are writing about. They're coming along very well. And I predict in the fall we'll have other antiviral agents, and hopefully they'll prevent the high mortality that's associated with that virus. That's kind of lumping those together, and we can come back on those. Next question from Anne Marie. Could you please discuss race and inequality and how the Fed's decision will impact Black Americans? It seems to be a choice between prioritizing economic choices versus choices that prioritize racial equity.
I'm happy to take a stab at that. I mean, as I say in my prepared remarks, the Fed doesn't have really good tools to address distributional issues or different classes of the population. You know, I think the Fed's theory is that if you can generate a strong economy, get the economy to full employment, that's going to be something that's going to aid people who are less advantaged, because they'll have more job opportunities, they'll be able to develop either human capital. But when you're sitting with relatively high unemployment rate, unfortunately, that disadvantages the poorest segment of the population. And obviously, there's certainly a racial element to that. I mean, if you look at African Americans, they have traditionally had a higher unemployment rate by a significant magnitude. And if you look at Hispanics, that's also the case. And, you know, we've seen that in the pandemic too, because a lot of the social distancing has required the shutdown of a lot of service industries where there's a high proportion of people of color who would otherwise be employed. So the crisis is bad for inequality itself. The burden is not being borne equally. The Fed doesn't have a very good tool set to deal with inequality. And that's why this really, in my mind, this is really a question of fiscal policy. This is where fiscal policy actually can provide more support. You know, Alan talked about extending unemployment compensation benefits. Alan talked about creating more aid to state and local governments. I think those are the things that can be done to mitigate some of the negative consequences to inequality.
Alan, you're on mute.
Yeah, just one thing very briefly. Jay Powell has gotten that question in a number of cases where I've been there. What he says, and it's true, is that, and I want to just embellish a little, in this recession compared to other recessions, the unusual burden on the low wage segment has been greater than normal. In a typical recession, you see, for example, a lot of high wage auto workers and construction workers laid off, and that's happening too. But what I said early on is that this hit the consumer service sector so hard. That's where you get a tremendous number of low wage people that have lost their jobs. And tragically, many of them are not covered by unemployment insurance. They should be. That's state by state, and in many states it's hard to get. So what Powell has answered when he gets those questions is, to the extent we can get the unemployment rate down, that will help the lowest wage workers probably more than the highest wage workers. And I think that in this particular recession, it's a realistic prospect.
Good. Thank you both. Jess, next question that's up. Do you think we can identify when the repercussions of distancing measures on the dynamics of respiratory infections like influenza will occur?
So with uncertainty, the range of projections that we've made so far, so it will hinge on how long the period of control lasts, because that determines how many individuals don't get infected and therefore are stored up to be infected later. But at least for influenza, I think the models projected that in most US states, and I think for respiratory syncytial virus, winter 2022, it will be a dark time. Of course, there's huge amounts of uncertainty in that. Influenza in particular evolves in complicated ways, but we can at least start bounding those expectations. And again, patterns of serology, good surveillance will give us a window onto the risk and the buildup of susceptibles to let us know that situational awareness could help design policy to avert burden.
Good. And Jess, on the current question, which has just been in the news recently, and is the WHO statement yesterday in terms of asymptomatic spread. And a number of questions have come in about that. But could you clarify that for our listeners? Because I think it is very important in terms of what the science tells us.
I think it's incredibly important. The moment that a press report went out, members of my extended family got in touch going, should we stop worrying? And the answer is absolutely no. Of course, it's very hard evidence to get transmission from asymptomatic individuals. By definition, individuals who are asymptomatic are showing no signs of infection. Generally, what people have used to try and pin down these sorts of processes have been contact tracing efforts. And there's a really important distinction, which is that between pre-symptomatic individuals. So this is where you're going to develop symptoms at some stage, but you're not showing them yet. And that seems to last 1 to 2 days for this infection. And then individuals who never show any signs at all. So it's harder to say exactly what's going on with individuals who never show signs of infection at all. But we have pretty strong evidence that for individuals who are pre-symptomatic, they're driving maybe more than 40% of onward transmission. And this is easy to understand, right? And I'm still feeling fine. That means I'm moving around about my life in the usual way, which means I could be driving onward transmission. Whereas if I'm feeling dreadful, I at least know something's going on, and I try and avert my cough. So it is, I think it was just a wording issue. That distinction between asymptomatic and pre-symptomatic is terribly important. I'm also not sure that the evidence is there to say anything conclusive about asymptomatics alone. But certainly, just because you're not showing symptoms, that doesn't mean you're not transmitting, is the absolute bedrock of what should be taken away from that.
Good, and that question came, among other people, from Grace Barber, class of 22 in the EEB department. And it is a very important one. Pre-symptomatic, and those 2 or 3 days before, people who become symptomatic, those 2 or 3 days before, it could be a little bit more, a little bit less, you are highly contagious. And that is asymptomatic, and it's pre-symptomatic, but of course you're asymptomatic at that time. So yes, you can be asymptomatic, especially if you're pre-symptomatic, and still be highly contagious. So thank you for that. Alan, this overall consensus forecast, what about if it is far from the mark?
Well, I think we're deeply in the soup. This comes back to another question. So if we have a second wave and it really knocks the economy for a loop, again, whether because of state-ordered lockdowns or just because people start doing it themselves, which is what was happening before the state-ordered lockdowns, the economy is going to experience another severe downdraft. And I was saying before, I worry about not so much about the borrowing capacity of the federal government, though that may start to become an issue, but the willingness of the Congress to put their shoulder to the wheel and really push to the limits of, or anywhere near the limits of what we can do fiscally to relieve this burden. As Bill was saying before, and I agree with that, I don't want to quite say the Fed has shot its wad, but there's a limited, very limited amount more that they can do. They can do more about financial repercussions. If some brush fire breaks out in commercial paper or wherever, the Fed can extinguish that, but that's not going to make a big difference on the state of the economy. So I do worry about the willingness of the political system, especially since the state and localities can't do it. So it's the federal political system to step up to the plate. So the answer to the question is, if there's a second wave, I hope there won't be, but if there's a second wave, it could hit the economy harder than the first wave.
Good. And Bill, feel free to add to that, but I have another question here, and that is the Fed is working very closely with the U.S. Treasury. Does this threaten the Fed's independence?
So let me just finish up on the first question. I completely agree with Alan that the Fed, they're not out of tools, they're not out of ammunition, but the supply is low. So if there is a second wave of the pandemic, it's really going to require fiscal policies, heavy fiscal policy lifting, because the Fed's not going to be able to do it all on its own. Well, in terms of the issue of monetary policy independence, I get asked that a lot. Should I be worried that the Fed is working so closely with the U.S. Treasury? I don't think there's an issue right now because the Fed actions have broad political support from both sides of the aisle. Everybody wants the Fed to intervene in an aggressive way. And so there's no the Fed's not deviating from what the political establishment wants them to, how they want the Fed to behave. I think the issue of independence might come up further down the road. You can imagine 3 or 4 years from now, when the Fed decides that we need to raise interest rates and the amount of federal debt outstanding is enormous. And if the Fed raises interest rates, the debt service costs on the debt will go up, and whoever the administration is at the time might be very unhappy with that. At that time, there may be divergence in interest between what the Federal Reserve thinks is appropriate to achieve its objectives of maximum sustainable employment and price stability, and what the Congress and the administration might perceive to be its goals, which is keeping the economy okay through the next election.
Okay, thank you. Jess, another for you. We have about 3 or 4 minutes to go here from John D. Jessica mentioned a potential benefit to controlled/differentiated rates of reopening schools and rollbacks of other policies. Are there any prospects of this actually happening in planned/designed way, or will we need to wait for observational studies to estimate these effects? Jesse, yeah.
So I think we should be using every drop of information we can. I do think that because the reopening is happening anyway in such a haphazard way, it's a real wasted opportunity and a squandered opportunity to learn a lot. So the question of schools actually links the question of asymptomatic transmission. We still don't really understand the role of children in transmission, and keeping schools closed is incredibly societally costly. And there are little pieces of evidence that people have pulled which are really informative, but are still very incomplete. From contact tracing, it looks like children are relatively rarely the index case of outbreaks. It seems that their viral loads might be lower. It seems that they show symptoms less, but we just, we don't have a complete picture on how that plays out or how that plays out in a broader setting. So I think it would be extraordinarily powerful if, since this is happening anyway, we could leverage those couple of weeks to build an information setup to measure both before and after in settings across the world. But I don't know of anyone who's doing it. But of course, so many things are happening so fast. It's very possible that I've missed it.
Good, thank you. Alan, if the US government reaches its borrowing capacity, will there be warning signs in advance?
Yeah, I think so. I think probably well in advance. And the two main ones will be interest rates starting to go up. And, another way to put the same point is even with large Fed purchases, that the Fed's having trouble keeping interest rates down. And second, the dollar. I mean, we've seen in crisis, the greatest example of which I talk to my students about, the world financial crisis started in America and it wound up pro-dollar because of the flight to quality. And when people get scared, they run to dollars. If we see people scared running away from dollars, that will be a big sign that something is wrong.
We got time for one more quick question, and this is to Bill, and thank everybody for their questions. And we have a number here, but we covered samples from most of them. Bill, another great question I think we'll close with. The Fed by its actions has bailed out highly leveraged companies, investors in junk bonds and others. How concerned are you that this will encourage greater risk-taking in the future?
Well, I think it will encourage greater risk taking to some degree because, some of the losses are essentially being socialized by the U.S. government, and we saw that in the last crisis as well. When you're in the middle of a crisis, the policymakers are faced with a tough choice. I can basically force people to bear the consequences of their actions, and if I do that, a whole bunch of innocent households and businesses will get hurt. Or I can come to their rescue and thereby support the economy and prevent that catastrophe to those who are innocent. So it's not surprising that we're seeing what's happening, but I think, I think we do need to recognize that there is a moral hazard problem, and we sort of have to ask ourselves the question, what should we do about it? And one thing I think we could think about is what problems are we seeing this time that we saw last time that we didn't fix? And there's a whole bunch of stuff going on in the non-banking part of the financial system where we're basically having some of the same issues come up again. Just to give you one example, just to wrap up here, why do we let people invest in highly leveraged, high yield debt and offer them overnight liquidity? So I can basically cash out my high yield debt bond fund with the next day, recognizing that these assets are actually very illiquid. Why not offer them monthly liquidity so that they actually understand that these are highly liquid assets? That's just one small change that one could make. But typically what happens when peacetime occurs, people forget the lessons of wartime and they don't fix all the shortcomings that we've seen during that period of stress.
I've got the one area that we haven't touched on, so I've got to slip it in, is the global implications. And I'll use this as just a quick entree to that. And then very quickly, I'd like for any of you to comment. This is from Mark. In past financial crises, there's been significant international cooperation. What are the economic and epidemiological implications of the relative lack of international cooperation on the current crisis? And again, it's a big, big question, but I'd love to give each of you 30, 45 seconds to comment on that. Anybody up first? Jessica, what about it?
Well, I mean, I think
an exchange of information and the great science work where there is a lot of cooperation undergoing. Why don't you take it from there?
It's a great start. It's been an incredible scientific endeavor, and I think it has been incredibly collaborative, and it's changed the way we do science, the sharing of preprints. I mean, there's also been a certain amount of garbage which has flowed out, but I think it's been extraordinarily positive in that direction. I think that, the thing that is obvious is that the virus knows no national boundaries. And so coordination is clearly important in thinking about how we battle it, how we come to terms with it. And you mentioned, Senator Frist, all the issues to do with supply chains, with making a vaccine, with getting it to the people most in need, with addressing inequities both nationally and globally as we move forward. So I think it'll be an interesting set of challenges, both in the past and in the future.
Okay, Bill, a global comment, and then Alan, a global comment, and then we'll close her down.
Okay, so my take on it is that I actually find it pretty depressing from an international perspective in terms of the international policy coordination. There hasn't been that much. And I'll give you one example of a really big problem that's coming down the road that hasn't really been addressed. And that's the stress that we're putting on emerging market economies. Those economies are going to be in great trouble over the next 6 to 12 months. And we haven't really made any significant progress in coming up with how we're going to address that from a global perspective. I'm where Jessica is. We're all in this together. And unfortunately, the political process is not providing that realization in terms of global cooperation.
Thank you, Alan.
Very quickly, I'm a big believer in international cooperation when all the countries are in the soup together. So in 2008-9, every country on earth understood they needed to do a fiscal expansion, and suddenly everybody was a Keynesian. That didn't last very long. When countries' individual interests differ, they don't cooperate, sadly. I hate to end this on an unhappy note. Maybe Bill, say something happy at the end, but one thing I worry about, one of the clinkers here, is once the worst of this is over, but we're still in very poor shape, what in the world is going to happen to world trade? We're almost on a wartime footing now about world trade. World trade gets killed by warfare. World trade is being killed by the pandemic. When it starts getting a little bit better, are we going to wind up reversing globalization to the detriment of the United States, but to your point before, really, really to the detriment of many poorer nations that rely on selling to the rich nations for a lot of their economic welfare?
Well, thank you. This conversation, I think, must be continued in the future. I do want to thank all of our listeners and viewers for joining us today for our COVID-19 webinar, a follow-up to our previous one, both of which will be able to be viewed at the website of the Griswold Center. We're sponsored by Princeton University's Griswold Center for Economic Policy Studies, the Center for Health and Wellbeing, and a Second Opinion podcast, Rethinking American Health. The full recording of this talk will be posted very soon on the Griswold Center's website, and then later this week on a Second Opinion podcast, which you can find on Apple and Spotify or wherever you get your podcast. We encourage you to share these with others as a resource. In closing, we clearly are in uniquely challenging times. The global pandemic and the major economic devastation that has resulted from COVID-19 has further exposed the inequities and things like racial injustice in our society. As we are working to rebuild our economy and to strengthen our defenses against what we know will be future challenges and future public health threats, we must build back so that we are equally valued, equally included, and equally protected. Thank you all for joining us today.